I don't imagine waking up, Bitcoin is up 8%, crypto Twitter is screaming, bull run is back, you FOMO in, and within an hour, the market crashes, your stop loss gets hit. Meanwhile, the same whales that caused the panic quietly buy back the coins you just sold. Coincidence? Not really. Today, I'm going to show you how institutional whales manipulate crypto prices and why understanding their playbook could completely change the way you trade. Let's dive in. Who are institutional whales? When people hear the word whale, they usually imagine one rich guy holding thousands of Bitcoin. But institutional whales are much bigger than that. We're talking about hedge funds, market makers, crypto exchanges, investment firms, and even companies managing billions of dollars. These players don't move markets because they're smarter. They move markets because they have something retail traders don't. Massive liquidity. When you're buying $500 worth of Bitcoin, you're invisible. But when an institution wants to buy $300 million, they can't just hit the buy button. They need someone on the other side willing to sell. And that's where price manipulation often begins. First, your liquidity hunting. One of the biggest games whales play is called liquidity hunting. Here's how it works. Most retail traders place stop loss orders in obvious locations, just below support, just above resistance. Whales know exactly where these orders tend to cluster, so they push the price toward those levels. Once enough stop losses get triggered, thousands of automatic sell orders flood the market. That creates even more selling pressure. Now the whales finally have enough liquidity to buy huge amounts at cheaper prices. To retail traders, it looks like the market suddenly crashed. To whales, it was just shopping season. Another common tactic, the fake breakout. Picture Bitcoin stuck between two price levels for days. Everyone is waiting for the breakout. Suddenly, the price explodes above resistance. Social media turns bullish. Influencers start posting rocket emojis. Retail traders rush in. Then, boom, the price reverses sharply. The breakout was fake. Institutions sell into the buying frenzy they just created. The same thing happens in reverse during fake breakdowns. Fear becomes their buying opportunity. Excitement becomes their selling opportunity. Fear and greed are the real targets. Here's something most beginners never realize. Whales aren't trying to beat your strategy. They're trying to trigger your emotions. Markets run on two powerful forces, fear and greed. When prices rise quickly, people chase. When prices fall hard, people panic. Institutions understand human psychology incredibly well. They know that emotional traders usually buy late and sell early. That's why experienced traders often say the market transfers money from the impatient to the patient. It's less about predicting prices and more about predicting people's reactions. Fourth, can you avoid being manipulated? Does this mean the market is rigged? Not exactly. Price manipulation does happen, especially in lower liquidity markets. But even in major cryptocurrencies, large players can influence short-term price movements. The key isn't trying to outsmart whales, it's avoiding emotional decisions. Instead of chasing green candles, wait for confirmation. Instead of panic selling, you understand why the price is moving. And instead of focusing on every tiny fluctuation, zoom out, because institutions often win the short-term battle. But long-term trends are driven by adoption, technology, regulation, and real demand. The next time you see a sudden crash or an explosive breakout, ask yourself one question. Is this real, or is someone creating liquidity? That single question could save you from making the exact mistake institutional whales are hoping you'll make. If you found this video helpful, hit the like button, subscribe for more crypto breakdowns, and let me know in the comments, have you ever been caught in a whale trap? I'll see you in the next one.